Global Settings section, you can make changes to the asset class assumptions, create your own model portfolios, or make changes to the ones we have created, and make changes to the Monte Carlo assumptions. To add an asset class, you can click on this plus icon. You can click on an existing asset class to change the annual return along with the percentage of return due to dividends and interest. If the asset class name is grayed out, then this means that this is one of the default asset classes that cannot be deleted. Changing the annual return will populate throughout all holdings, since all holdings are assigned to an asset class, unless you have overridden the annual return for the investment account where the holding resides. You will also see assumptions for the percentage of return due to dividends and interest. We use these to determine how investment growth is taxed each year. Any portion of the annual return not due to dividends or interest is assumed to be the portion of the annual return resulting from growth in the principal due to a price increase of the investment. This is the portion that will be taxed as capital gains when the gains are realized. In this case, we are looking at the default asset class for cash, where 100% of the return has been attributed to interest, meaning 100% of the return will be calculated as interest income, and no capital gains will be owed if the investment is sold. Similar to the asset class mapping screen, to add a model portfolio, you can click on the plus icon. And to edit an existing portfolio, you simply click on it. You can use these model portfolios when adding a future asset reallocation and to run asset allocation scenarios. You will notice too that any custom asset classes that you have created will also be included here and can be used to create your model portfolio. You can make changes to the standard deviations and the correlations used in our Monte Carlo simulations. You will also see the option to change the distribution to use the Laplace distribution, meaning extreme events are more likely to happen than in the normal distribution. The standard deviations determine the volatility of the returns in each year for each asset class. The higher the standard deviation, the more volatile and extreme, both highs and lows, the returns will be. The correlations are very important when determining the return of an asset class compared to others. For example, if long-term bonds have a negative 0.28 correlation with growth stocks, this means when growth stocks have a bad year in Monte Carlo simulations, long-term bonds will usually have a good year. This is referred to as diversification, and the more negatively correlated assets one has, the more diversified they are, which helps dampen the volatility of the overall portfolio. The WealthTrace support team is here to help you create your accurate and comprehensive retirement and financial plan. We have several options for support. You can use our excellent live chat support during normal business hours. If there are no live agents, you can leave us a message and we will get back to you as soon as possible. You can search our extensive knowledge base, where you can find answers to our most frequently asked questions. You can also email us at support@mywealthtrace.com or use our support contact form on the website. We also have an option for one-on-one expert planning help, where you can sign up for a paid one-on-one session with Doug Carey, who is the founder of WealthTrace and a chartered financial analyst. Doug will walk you through your settings and assumptions and make sure you haven't made any errors. He can also help you model more complex scenarios and give you feedback on your results.